In simple terms, credit card interest rates are the price you pay for borrowing money from your credit card issuer. It's a percentage of your outstanding balance that gets added to what you owe. But here's the kicker. These rates aren't just pulled out of thin air. They're largely influenced by the Federal Reserve's benchmark rate. So, when the Fed recently decided not to raise this rate, it sent ripples through the finance world. But why should you care about all this? Well, these rates directly impact your wallet, affecting how much you end up paying back on your credit card debt. Before we move on, do us a favor and hit that like button. Subscribe to New Way Finance Academy and turn on notifications so you never miss our insightful content. You might think that the Federal Reserve's decision not to raise its benchmark rate would mean relief for those with credit card debt. However, that's not necessarily the case. In the vast ocean of credit card debt, the waves are getting higher as delinquencies and debts continue to rise, irrespective of the Federal Reserve's pause on rate hikes. This, my friends, is a sobering reality for many American households. It's a game of numbers, and these numbers don't lie. Banks, the captains of this financial voyage, are not lowering their sales. Instead, they are maintaining high interest rates, or even increasing them slightly, in an attempt to shield themselves from the stormy weather of defaults. This is a strategic move, a form of risk management, if you will, as they navigate through the choppy waters of the credit market. Now let's talk about outstanding credit card balances. Hold on to your seats, folks, because they have surpassed the staggering mark of $1 trillion. Yes, you heard it right. $1 trillion is the collective debt we're talking about. And what about the average percentage rates, or APRs as they are commonly known? Well, they are at their highest level in nearly 4 decades. That's right, 4 decades. Average interest rates on credit cards are now higher than they've been since the early 80s. But that's not all. The delinquency rate on credit cards, which represents the percentage of borrowers who are late on their payments, has also seen an uptick. This is a clear signal of distress, an SOS from borrowers struggling to stay afloat. It's a tough world out there, folks. Banks are tightening their lending standards, making it harder to get credit cards and loans. This is like a double-edged sword, where on one side you have rising rates, and on the other, limited access to credit. These statistics might seem daunting, but there are ways to navigate this landscape. So, hang in there, because knowledge is power, and understanding these trends can help you make informed decisions about your financial future. High credit card interest rates can have a significant impact on consumers' financial health and well-being. Let's talk about this. When interest rates rise, the cost of borrowing money also increases. This means that every time you make a purchase with your credit card and carry a balance, you're paying more for that item than you would if interest rates were lower. Over time, these additional costs can add up, leading to increased debt. Now, let's imagine you're in a situation where your credit card debt is growing because of high interest rates. This can make it more difficult to pay off your balance, especially if your income isn't increasing at the same rate as your debt. The longer it takes to pay off your debt, the more interest you'll end up paying, creating a vicious cycle of debt that can be hard to break free from. And the story doesn't end there. High credit card interest rates can also make it harder to obtain additional credit cards or loans. Why is this, you might ask? Well, when you're carrying a high amount of debt relative to your income, lenders may see you as a riskier borrower. This can lead to your applications for new credit cards or loans being denied, or you may be offered credit at even higher interest rates. In the worst-case scenario, high credit card interest rates can even lead to bankruptcy. If your debt becomes unmanageable and you're unable to make your payments, declaring bankruptcy might become your only option. While bankruptcy can provide some relief from debt, it also has long-term consequences, including a significant impact on your credit score. So let's sum it up. High credit card interest rates can lead to increased debt, difficulties in obtaining new credit, and in extreme cases, bankruptcy. These are serious consequences that can affect your financial future for years to come. Understanding these consequences can help you make informed decisions about your credit card usage. Armed with this knowledge, you're better equipped to manage your credit wisely and avoid the pitfalls of high interest rates. Even in the face of rising interest rates, there are strategies that can help you manage your credit card debt more effectively. Let's dive into this topic now. Firstly, It's important to know your current interest rate. This information is typically found on your monthly statement, or you can call your card issuer to inquire. Once you have this information, you're better equipped to negotiate. Now let's talk about negotiation. Contrary to popular belief, credit card interest rates are not set in stone. Many issuers are willing to lower your rate, especially if you have a history of timely payments. So pick up the phone and make that call. Be clear, be polite, and state your case. If you've been a loyal customer, or if you've received lower rate offers from other companies, don't hesitate to mention this. But what if your issuer won't budge? Well, there's always the option of switching to a different card. Look for cards offering 0% interest on balance transfers. This could provide you with a window of several months to a year to pay down your debt interest-free. However, be aware of any balance transfer fees, and make sure to read the fine print. Now, here's a pro tip. When you're negotiating, don't limit yourself to just discussing the interest rate. Ask about other fees and charges as well. For instance, you might negotiate a lower annual fee or even have late payment fees waived. Every little bit helps when you're trying to manage your debt. Lastly, remember that these steps require persistence. You might not get a yes on your first try, but don't let that deter you. Keep trying, keep negotiating. It's your money, and every penny counts. By taking these steps, you can potentially save hundreds or even thousands of dollars in interest payments. So don't wait. Start your negotiation journey today. While it's impossible to predict the future of credit card interest rates with certainty, understanding the current trends can help you prepare. The landscape of credit card interest rates is a dynamic one, shaped by a multitude of factors including economic conditions, inflation rates, and lending practices, among others. Looking at the current trends, the trajectory seems to be pointing upward. Despite pauses by the Federal Reserve, credit card issuers are maintaining high interest rates, and in some cases, even increasing them slightly. This is a protective measure against rising delinquencies and debts. The reality we are facing is that outstanding credit card balances have surpassed $1 trillion, with average annual percentage rates at their highest level in nearly 4 decades. Now, you may wonder, how does one prepare for such a future? The key lies in staying informed and taking proactive steps. Firstly, it's crucial to maintain a keen awareness of your own financial situation and capabilities. Understand your credit card's terms and conditions, especially the interest rates, and how they can impact your financial health. Secondly, consider your options. If your current credit card issuer isn't willing to negotiate a lower interest rate, there are always other fish in the sea. There are credit cards out there offering 0% balance transfers, which could be a viable option. Lastly, adopt responsible credit habits. Pay your balances on time, avoid maxing out your credit cards, and strive to maintain a healthy credit score. These practices can go a long way in mitigating the impact of high interest rates. The future may be uncertain, but that doesn't mean you can't be prepared. By staying informed and taking proactive steps, you can navigate the world of credit card interest rates with confidence. We hope this video has given you a deeper understanding of credit card interest rates and how to manage them effectively. If you enjoyed it, don't forget to hit that like button, subscribe to New Way Finance Academy, and turn on notifications. We've got a lot more valuable finance insights coming your way. Stay tuned for our next video where we'll explore another hot finance topic. Stay tuned for more insightful finance content from New Way Finance Academy. Until next time, stay smart and stay financially savvy.